Um, I guess a starting point is, this has been just an extraordinary 15 months we've been through. Um, and the COVID-19 epidemic remains first and foremost a public health emergency that continues to cause widespread suffering and disruption in Canada and around the world. The economic consequences have also been massive, with job losses that exceed those of any recession in Canadian history, both in their number and in their sheer suddenness. As vaccination rollouts speed up and cases trend down, we can start to imagine better times, but we're still a long way from a complete recovery. Too many people remain out of work, particularly in the sectors hit hardest by lockdowns and physical distancing measures. These have been tough times for many. Yet on the whole, the Canadian economy has come through better than expected. One important reason is the large-scale government support that boosted household disposable incomes and kept many companies afloat. At the Bank of Canada, we also did our part by helping to keep credit available and its cost low. Throughout this period, the resilience of Canadian households and businesses has also been striking. This resilience has been enabled in part by the digital technologies that have become more widespread, giving us new ways to shop, serve customers, and work remotely. The pandemic has not only accelerated the digital transformation that was already underway in Canada and globally. My remarks today will offer a progress report on the economic recovery in Canada, putting some context around the interest rate decision that we announced yesterday. I'm also going to make some observations about the digital transformation and what it means for where the economy is heading beyond the pandemic. We've spent the last year climbing out of a very deep hole. During the worst of the pandemic, the Canadian economy contracted by almost 15% and lost about 3 million jobs. Economic activity and employment both rebounded strongly last summer, but the second and third waves of the virus each brought setbacks, so real activity and employment are still below pre-pandemic levels. By April of this year, when the bank published its latest monetary policy report, or MPR, there was reason to be more confident in the Canadian economy's resilience. Despite renewed lockdowns, we were seeing signs of strong growth in the first quarter. Households and businesses had clearly adapted better than expected. Job losses were mostly in sectors where activities are hard to physically distance. Canada's export markets were improving too, led by the United States thanks to its rapid vaccination rollout and substantial fiscal stimulus. Then, the third wave of COVID-19 dealt Canada another blow this spring. More contagious variants were spreading around the world and across the country, adding new uncertainty and straining hospitals in some areas. This slowed many people's return to work, particularly in contact-intensive sectors, and led to further job losses. But with Canada's vaccinations now in high gear and lockdown measures helping to contain the virus, this setback should be temporary. The economic data that have come in over the past few weeks provides signs of increasing resilience that bode well for the underlying recovery. One key piece of information that arrived last week was the national accounts data. These show that real GDP in Canada grew by about an annualized 5.5% in the first quarter, bringing the level of GDP to only 1.75% where it was below the pandemic, and that's in contrast to the 15 that I mentioned earlier. The first quarter result was a bit lower than the 7% that we projected, but the data are quite encouraging. Household spending was even stronger than expected. GDP growth wasn't as high as in our projection, but that was mainly because businesses were drawing down their inventories and increased imports more than anticipated. Overall, the data provide indications of rising confidence and resilient demand. They confirm that the Canadian economy is heading for a strong first half of 2021, despite the most recent lockdowns. We still expect positive growth in the current quarter, close to the 3.5% we were projecting in April. That being said, the latest labor force survey released on Friday shows that there were 275,000 net job losses over April and May during the renewed lockdowns, and that the unemployment rate is still above 8%. I'd like to mention a few key elements of the economic picture. One is housing, which has provided a strong boost for the economy during the recovery. Signs of moderation have appeared in recent weeks, but the level of activity remains very high. The housing boom has been driven by both a desire for more living space and by low mortgage rates. And the desire for more space, in turn, has been driven partly by the fact that digital technology has made remote work seem like a viable option for many people, even after the pandemic is over. But as we've noted, there are also signs that extrapolative expectations, the fear of missing out, are taking hold in some markets. So we are watching this closely. Another important factor has been the strong gains in world prices for oil and other commodities. This mainly reflects the brightening prospects for the global economy, and it is good news, especially for Western Canada and other oil-producing regions. It offers some relief from last year's commodity price collapse, which came after 5 years of painful adjustment to the earlier plunge in oil prices. Inflation, meanwhile, is a more complicated story than usual. Many prices plummeted at the onset of the pandemic, and inflation was running well below our 2% target until quite recently. In April, though, consumer price inflation increased to about 3.5%. This was largely in line with what we projected in our April monetary policy report. It reflects the fact that year-over-year inflation is comparing today's prices for a range of goods and services with last year's rock-bottom prices, so-called base year effects. It also reflects higher gasoline prices and other temporary factors. We expect inflation to stay around 3% through the summer and then to ease later in the year as remaining slack in the economy pushes inflation down. As we said in April, there is unusually high uncertainty about how much policy support will be needed and for how long. That's partly because of the uneven economic effects of the pandemic. It's also, though, because the pandemic may be accelerating structural changes in the economy, making it hard to gauge the economy's potential to grow without creating inflation. Here, a key element is the adoption of digital technologies. So let me spend a few minutes now discussing that.
I'll take this second to say, just to give you a little bit of context, this is Tim Lane, right? This is the Deputy Governor of the Bank of Canada. We're going to let him continue here in a second. But important to consider is he's been one of the head developers in the Bank of Canada's CBDC. Now, if you haven't heard of a CBDC before, that stands for Central Bank Digital Currency. And it's the talk of many different nations across the world as we see so much adoption of cryptocurrency and these sort of digital ledgers of transactions. Central banks are considering, hey, how can we get in there and create our own that we could potentially use so that we can still have some power over the economy before everyone switches over to cryptocurrencies. This is something that's being developed, and he's given speeches on that before. So it's important to consider that when he's talking about tech here.
Now, anyone with a smartphone knows that digitalization was well underway before the pandemic. Investment in information and digital technologies has been solid around the world, including in Canada, for several years now. We can see this transformation most directly in the growth of the tech industries. Computer design and related services, which is a proxy for the digital sector in Canada, started growing almost 3 times faster than the overall economy in 2013. By 2019, economic activity in that digital sector made up almost the same share of Canada's economy as mining, oil, and gas combined. But the impact of the transformation extends well beyond the tech industries. All kinds of service providers, from banks and insurers to telecommunications firms and governments, have harnessed digital technology to improve their operations and interact with their clients. Retailers have expanded online platforms and made them increasingly user-friendly. Digital technologies are also transforming the goods producing and commodities sectors. Auto manufacturers have used increasingly sophisticated robots for decades, and in more recent years, other industries have been following their lead. And the energy sector uses automation, artificial intelligence, and machine learning to cut costs and emissions and to make work sites safer. Through the COVID-19 recession, digital technologies have played a central role in safely sustaining economic activity. One obvious example is video conferencing technology, such as what we're using today, which has allowed millions of Canadians to do their jobs from home. And then there are the apps that allow people to order from restaurants and shop with limited physical contact. The need to quickly adopt and even develop technologies during the pandemic has given the digital sector added momentum. While the Canadian economy as a whole shrank by about 5% in 2020, the digital sector grew by about 3.5% and continued to accelerate into 2021. This has helped support employment through the pandemic. Technology-driven adaptation has also changed the types of jobs that are available. There have been fewer openings for servers in restaurants, but more for delivery drivers, and fewer for in-store retail sales clerks, but more for people in warehouses fulfilling online orders. We've also seen ever-expanding opportunities for people with digital skills, skills that were already in high demand before the pandemic. For instance, there have been fewer openings for events planners, but more for people to manage social media communities. And as workplaces have adapted to virtual operations and remote work, companies of all kinds have sought people to produce and support their digital infrastructures. These developments show that the digital transformation has been accelerated by the pandemic, and they suggest that it could continue to accelerate beyond the current recovery. Growing evidence that the pandemic has pushed firms in all sectors to overhaul their business models more aggressively than planned. Roughly half of the Canadian executives who responded to our spring Business Outlook survey said that it has sped up their adoption of digital technologies. Still, it's going to be challenging to capitalize on the opportunities that this transformation presents. Businesses are already having trouble finding people with the right skills, and these skill shortages could intensify in the coming years. Moreover, the opportunities could be distributed unevenly. Some people could even see fewer opportunities, at least at first, as some businesses use technology to replace workers or struggle to remain viable. Many of the jobs that could be displaced are also those that have been hit hardest by the pandemic. Jobs that are disproportionately held by women, young people, low-wage earners, and racialized Canadians. This all underscores the importance of working to equip all Canadians to take advantage of the expanding digital opportunities. This is a key policy challenge. Education, job training, and labor market policies are essential to prepare Canadian students for the digital economy and to enable workers to transition to the jobs of the future. Governments, academic institutions, and businesses all have roles to play here. Now, let me bring this back to the Bank of Canada's responsibilities. We make monetary policy decisions to achieve our 2% inflation target on a sustainable basis by supporting the economic growth required to get there. And we have been very successful. Inflation has averaged just under 2% over 3 decades. A key question in this context is, once the pandemic is behind us, what does the digital transformation mean for the Canadian economy's potential output? That is, for how much the economy will be able to grow without sparking inflation. Most severe recessions have a prolonged negative effect on potential for two reasons. First, the widespread economic disruptions of a recession tends to cause some firms to delay or cancel investments and others to shut their doors. That reduces the economy's capacity to produce, which limits its growth. Second, when people face a long spell of unemployment, their skills tend to get rusty and they lose touch with the job market, making it harder for them to get back to work. This is known as scarring. It reduces the economy's workforce and its overall productivity. There is no doubt that the recession caused by the pandemic, like all recessions, will result in lost capacity and scarring. But the accelerated digital transformation has supported resilience so much that we now think the damage to potential will be less than we earlier feared. In our latest monetary policy report, we updated our estimates of potential output as we do every April. Based on the resilience that we've seen over the past year, we estimated that the effects of the pandemic had lowered potential less than we had thought they would. We also estimated that the accelerated adoption of digital technology would boost productivity growth. We took a cautious view, though, because the size and timing of this boost are both highly uncertain. But there is a good chance that productivity growth, a key driver of potential, will be stronger than expected, giving the economy more room to grow before inflation becomes a worry. I should stress that there is always a lot of uncertainty around our estimate of potential output, and this is particularly true these days. We've never seen a recession or recovery quite like this one, with such widely different effects across sectors, businesses, and groups of workers. Also, the restrictions have affected both demand and supply. That makes it harder to interpret economic signals. As well, the digital transformation itself is a source of uncertainty. First, because it's difficult to predict the future benefits of innovation. And second, because these benefits can be very hard to detect and measure while they're coming about. In fact, it's possible that much of the investment that enhances productivity isn't even showing up in the statistics. That's because cloud services or databases are less tangible and therefore harder to measure than, say, buying and installing a new line of factory machinery. Measuring intangible investments that travel across borders is particularly difficult. Given the unusually high uncertainty around potential and its future growth, we'll need to rely on a wider range of information than usual to assess how much slack exists in the economy. That assessment is key to deciding when to start scaling back our monetary policy stimulus. As we said in April, this will include looking at a range of indicators of labor market conditions. We will have more to say about that in our next NPR in July. The main message I want to leave you with is this: the digital transformation has not only been very helpful during the pandemic, but it also stands to increase our productivity and, in turn, our growth potential for years to come. But we have to be mindful of the challenges associated with this transformation and do all that we can to put people and businesses in the best position to benefit.
To that in just a moment, but let's go over a quick summary here of what we've heard from him. So this is again Tim Lane, the deputy governor of the Bank of Canada. Lots of information in here. One of the key points that he's pushing on is the fact that Canada is transitioning, in his eyes and the Bank of Canada's eyes, to a digital economy where more of those skills are going to be important. Now, because of this transition and how we haven't really seen an economy like this before with the pandemic and the way that there's been sort of an uneven recovery in different sort of socioeconomic statuses, well, he's saying it makes it very, very hard to predict what's going to be happening going forward in the future, because they can't look at the same key indicators to determine their forecast for the future. They're going to have to look at a lot more labor market data, is what he's saying, and that there might be scarring from the pandemic and people getting rusty with their skills, and that might mean slower growth. But how much will that be offset by the implementation of new tech that's sort of been accelerated through the pandemic here? Some interesting points, and I'm seeing some people in the chat. If you're in the chat and you haven't said hey yet, make sure to drop a comment there. I'm I'm reading it as we go here. We're seeing Matt and El Ezra in there, and Antoine and Laurel, and product reviews, and Quasimodo, and Candace, as always, hanging out in the chat. I'd love to see you guys in here. Let's flip back here and see if he's going to take any questions from reporters, because usually that's where we get the juiciest information, because the reporters often ask the questions that the central bankers don't want to actually answer. So we're looking forward to that. And actually, after this press conference where he's doing this speech, it'll actually switch over to a media availability where like our authors and journalists from the Globe and Mail and CBC and a whole bunch of different other sort of news outlets will actually be able to ask Tim Lane, this deputy governor of the Bank of Canada, some hard-hitting questions, hopefully. But let's switch back and see what else he has to say.
Now, for the benefit of our wider web audience, I'm going to repeat this last few words and a few others later in French. Le message à retenir, c'est que la transformation numérique a été très utile pendant la pandémie. Elle devrait aussi augmenter la productivité et donc le potentiel de croissance de notre économie à l'avenir. Mais cette transformation pose des défis. Et il faut tout faire pour que les gens et les entreprises puissent en profiter.
All right, so you guys know that my French isn't the best, so I'm going to skip through this. We have a little bit of slack here because of the times I've paused it. We'll hopefully get back to English. At some point, we got to get an official translator for this who can come on and do translations for us.
Our view of the outlook. Sensitive sectors, the same sensitive sectors, okay, the same jobs and the same people who've been most affected by previous shutdowns. The employment rate remains well below its pre-pandemic level, with women, young people, low-wage earners, and racialized Canadians continuing to bear the brunt of job losses. The good news, though, is that vaccinations are rolling out at or faster than the pace we assumed in April. We've also seen other economies, such as the United States, pick up smartly as they have reopened. These developments are encouraging and suggest that we are on track for a strong consumer-led recovery as containment measures ease here in Canada. Et en français, mais il y a de bonnes nouvelles. La vaccination.
Hey, thanks, Frank. Thanks for tuning in. Thanks for the super chat. I appreciate that. Always nice to have some regular supporters in here. I've seen Candace and Frank and Antoine I've seen before, and Twister. Lots of people in here that we've seen before, and Alex, as always, hanging out.
Suivant le lever des mesures sanitaires. The risks of the inflation outlook identified in the April NPR on both the upside and downside remain relevant. These include the possibility of more infectious new variants, of stronger household spending in Canada and stronger growth in the United States, the potential for weaker exports because of a stronger Canadian dollar, stronger potential output, which I've been discussing earlier in my speech, and finally, the potential for more persistent cost pressures to drive up inflation. So let me come back to one issue on which Governing Council discussed in particular in the lead to yesterday's decision, inflation. This shouldn't be a surprise since our job is to deliver low and stable inflation. As I already mentioned, inflation in April came in above 3%, and we expect it to stay around 3% over the next several months before moderating. While inflation over this period is likely to be higher than we projected in the April NPR, the underlying story is the same. Most of the run-up in inflation is simply arithmetic, the base year effects I've already talked about. Gasoline prices in particular are much higher this year than they were last year, partly because they had fallen so much a year earlier, but also because global oil prices have been rising in recent months. Indeed, commodity prices more generally have rebounded through the first half of this year in response to prospects for stronger demand as the global economy recovers. But these base year effects are by definition transitory. They will not persist beyond the next few months. What will persist longer until we see a complete recovery is the underlying slack in the economy. This slack will continue to put downward pressure on inflation even as the base year effects are fading. I mentioned the risk of more persistent cost pressures that we identified in the April MPR. Some of these could come from higher prices for raw materials that businesses use to make their products. Some of these pressures could also come from supply chain bottlenecks as the economy reopens and demand temporarily exceeds supply. Indeed, we have seen supply chain issues globally in products such as semiconductors and in countries such as the United States, where businesses have had more difficulty rehiring workers. These supply chain bottlenecks will likely become unblocked as things normalize, but it is a risk that we will be monitoring closely. All of this brings me to yesterday's policy decision. The Governing Council judges that there remains considerable excess capacity in the Canadian economy and that the recovery continues to require extraordinary monetary policy support. We reaffirmed our commitment to hold the policy interest rate at the effective lower bound until economic slack is absorbed so that the 2% inflation target is sustainably achieved. Based on our April projection, we expect this to happen sometime in the second half of 2022. We also reaffirmed that we are continuing our quantitative easing program to reinforce this commitment and to keep interest rates low across the yield curve. In that context, we maintained our pace of weekly purchases of Government of Canada bonds at a target of $3 billion. Decisions regarding adjustments to the pace of net purchases will be guided by the Governing Council's ongoing assessment of the strength and durability of the recovery. As Governor Macklem said in April, if the recovery evolves in line with or stronger than in our latest projection, then the economy won't need as much QE stimulus over time. Given the reopenings happening in many parts of Canada, we expect to learn more over the coming weeks to further inform that assessment. Nos décisions futures sur les achats nets vont dépendre de notre projection. Canadians can count on us to provide the appropriate degree of monetary policy stimulus to support the recovery and achieve the inflation objective. Thank you. Now I'd be happy to answer your questions.
Okay, interesting. So it looks like we're going to get some questions from the room here. I think this is a panel of financial advisors.
Deputy Governor Tim Lane. My name is Laurent Meunier, calling in from Vancouver, and we've got a question from the chat talking about lower interest rates. So are lower interest rates the only reason for the real estate frenzy in Canada? And where do you see these interest rates going in the coming weeks or months?
Well, as I mentioned in the speech, there are really two main drivers of the very hot real estate market, and one of them is just the fact that there's been a change in households' behavior that's taken place, and part of it is people are stuck in their four walls and they're just demanding more space, and also they can't spend money on other things they might normally be spending money on. They can't go out to restaurants, they can't go on holidays, and they don't care about wearing clothes because nobody's going to see them, so they basically they have money that that in many cases they're using to try and shop for a better house. And of course, in the short run, the stock of houses is fixed. So when you have this surge of demand for more space meeting a fixed supply of housing, that pushes house prices up. Now, the other thing, of course, is interest rates are very low, and that's enabled households to finance larger, more expensive houses than they previously had been able to do, and that certainly is an important contributing factor. Now, at this point, of course, the need for low interest rates is really driven by the economic needs of the whole of Canada. We're not targeting that to the real estate market, but instead we're recognizing the fact that, we've still got 500,000 fewer people in employment than was the case before the pandemic hit, and we still have to keep conditions favorable so that the economy will grow its way out of this hole, and those jobs will come back. And that's basically what's driving our interest rate decision. But as I said, over time, we expect the economy will recover, and then we will be in a position to start withdrawing some of that monetary policy stimulus, and that will, of course, be a factor when it happens that will contribute to rebalancing things.
So talking about that balance, right? Like, do we support jobs with low interest rates, or do we slow down real estate growth by raising them?
talking about economic and labor force impacts.
Okay.
What would be the economic and labor force impact of businesses bringing employees back to work in person? And many businesses have recently announced that they're not going to be allowing employees to work at home as much in the post-pandemic time.
Well, we're all, I mean, it's been a very unusual time. And I think the last, as I said at the outset, it's been extraordinary the last 15 months, how many of us have adapted to working at home and found that we can still work quite productively. But I think every employer is sort of making a different decision about this and trying to decide what actually works best for the organization. There's certainly some benefits to having workers having the flexibility of being able to work from home to sort of balance their family commitments with their work commitments and avoid the commute that many people suffer through every day. And on the other hand, of course, there are some benefits to people being congregated. People often feel more productive when they've got colleagues around. They can interact informally. They can collaborate on work and that sort of thing. And so I think what remains to be seen is, two things. One is where most companies end up. I think a lot of companies are going to, and that also includes public sector government, and we're doing much the same thinking ourselves. Trying to sort out what's actually going to work the best and how much flexibility is desirable. But then, of course, depending on how many people do end up working from home on a more permanent basis, or how much that's sort of full-time versus part-time, you could have changes in you could have important changes affecting the economy. For example, businesses might find they don't need as much office space. Households might want to have bigger houses so they have room for a home office, and so those sorts of changes and the effects on people's need for cars to commute with, the need for public transit. So there are pretty wide-ranging changes that depend on those changes. And I have to say, we haven't got a complete scenario of how this would play out, but just to say that it's going to be a very important driver of the Canadian economy and the world economy going forward. You're on mute.
No, he's muted.
Somebody had to do it. Here we've got another question. This one's more specific, and it's actually from a client of one of our advisors here in Vancouver. So says, I'm currently renovating my house. And so from the time that I drew up the plans to now when the hammers are hitting the nails, the price of wood has tripled. My electrician has actually just doubled the quote for raw materials, and anything made out of metal is up at least 50% and has a 6 to 8 month wait time on delivery. So from what I see, gas prices are up, food prices are up, everything that I see and do is up, but the Bank of Canada says that they're working at reaching an inflation target. So how is there such a large disconnect between what us consumers see and what the bank is saying about inflation? And how can you square that circle for a layman?
Well, when we look at inflation, it's measured by the Consumer Price Index, which is put together by Statistics Canada, and that includes all the prices of all the things you mentioned. Not the inputs, but it includes the final price to the consumer, the fact that a new house costs more, and that's built into their measure of the cost of housing. But although there are some other there's some other complications to how that's incorporated. It's not the cost of buying a house, but the ongoing cost of living in a house. But it's basically those things all are factors. But certainly the overall increase in the Consumer Price Index is still. It's a little bit more than 3%, and it is pushed up by a number of temporary factors, as I mentioned. We're also, of course, looking at the possibility of some of these cost pressures in raw materials and things like that feeding through into inflation more than we have seen so far, and more than we are currently expecting. And that's something that we are, of course, keeping a close eye on. But so far, based on what we've seen in the data coming in, our assessment is that this recent rise in inflation is temporary, and that we should see inflation coming back down to its target of 2% over the course of the next year or so, and that's basically coming out of a period where inflation was closer to 1% during the pandemic. So we're really, of course, we've got variations in 1 year of very low inflation, 1 year of higher inflation, but we expect that when we come out of this episode, that inflation should be converging to its 2% target.
Interesting. I want to pause on that for just a second, because that essentially what he was asking is like, hey, how do you reconcile these two views of what's happening with inflation right now? The person who typed in that question that guy then asked Timothy Lane here, the Deputy Governor of the Bank of Canada, well, it was essentially saying that, hey, we know that the Bank of Canada uses the CPI, or the Consumer Price Index, to gauge inflation, and they say it's been at the average of in that 1 to 3% or 2% target band that they're looking for. But what the question asker was saying here was like, how do you reconcile the fact that you have this data, but like from a day to day, like the consumers that are seeing it feel like the inflation is so much more? Of course, there are some issues with the CPI that the Bank of Canada uses to measure inflation. A lot of critics of the CPI, and you can let me know what you think about this, say that the CPI doesn't actually accurately reflect inflation, and that right now the CPI would be far higher if there weren't lower interest rates, which are controlled by the Bank of Canada. Because the way that they take into consideration housing in the CPI is mortgage payment, or the mortgage payment amounts. Now, because we have lower interest rates right now, people have been refinancing their mortgages and buying new houses at these extremely low rates. So their mortgage rates and their mortgage payments have gone down significantly. Now, when that is put into the CPI, it's like a deflationary pressure on the CPI, but it's only a deflationary pressure because the interest rates are low, and that's created by the Bank of Canada. So that's one of the most interesting critiques of the CPI that I've seen lately. So interesting to hear him talk about that. Not really a really strong answer on why they can't reconcile like what's going on with the Bank of Canada, what they're looking at, and how that's different from what the consumers are seeing on an everyday basis.
You're on mute again.
Again, here's another one from the chat. What is the bank's view on the impact of the future economy of the nation's massive debt load? So how does Canada federally and provincially reduce that debt? And is this something that we're trying to do?
Well, I guess the first thing to remember here is that this has been an extraordinary period where there's been really an unprecedented economic contraction, and where it's been essential to tide the economy through. I mean, the economy is, to a certain extent, been on life support, has been needing a massive infusion of money from the government. Government's been in a position to borrow and provide money to households to support their incomes through this period, despite the fact that so many jobs were lost, and also to keep businesses from failing during this period. So there's been a lot of support to businesses, which has meant that they'll sort of live to fight another day. Basically that that they've been able to survive and should be in a position to reopen when the restrictions connected with the pandemic are lifted. And so that's really the source of this increase in debt. Now, of course, what we have to look for is where we land when we come out of this episode, and it's important for the debt to be sustainable, and that, of course, depends on the rate of growth of the economy being sufficiently rapid that the debt is not actually increasing over time as a share of the size of the economy. Now, at this point, that means that many of these measures that were taken during the pandemic have to be viewed as temporary, and they obviously are expected to come off, and that should move us into a position where the debt dynamics are sustainable. Now, the more specifics around how to do that, and the current budget, of course, is not really the Bank of Canada's responsibility, but certainly that's the basic story which underlies the debt situation. And that's something that we're, of course, treat as the broader context in which we're making decisions on monetary policy.
Actually, this next question here from the chat again segues right off that last point that you were making about the consumer-led recovery, and that you mentioned a couple times in your speech here. So you referenced the consumer-led recovery a couple times in your speech, but many small and medium-sized businesses have been decimated by pandemic policy decisions. So is a consumer-led recovery in light of this likely permanent damage? Is that a reasonable assumption when consumers that are affected by these policies may not have a business or a job to go back to? And then what's the bank's view on what policy decisions are needed for a sustained recovery with real growth in the economy?
Well, certainly these have been tough times for businesses and for consumers. But the good news is that because of the volume of support that's been provided, and the fact that the credit has also kept flowing to businesses, the number of actual closures of businesses has actually been below the level that normally takes place. I mean, many businesses have been able to continue, and so although any recession it does have its scars. You know, any recession results in businesses failing and new businesses having to take their place, which can take longer. Then this recession seems to be one where those scarring effects have been reduced substantially by the level of government support, as well as by the digital technologies that I was talking about. The sense that a lot of businesses have found ways of still continuing to do business, and just thinking of many restaurants that seem to have been able to do quite a booming business off of delivery services, and in many cases, you know, have actually been doing reasonably well. Now, obviously, what remains to be seen is sort of how this evolves as the economy reopens. But certainly, the intent, as we hear it, is that these support measures will basically phase out as the economy is in a position that the support's no longer needed. And so, as consumers are coming back on, and as the restrictions are lifted, so we can go out and shop and go on trips and go to restaurants and all that, then the businesses will be able to reopen and become profitable again. So that's certainly the hope as we get out of this period.
Here's another one from the chat. Thank you so much. Again, on a similar topic, we see that inflation is rising, and at some point in the future, this may require raising interest rates. Is there a concern in raising interest rates while Canadians are so heavily indebted with such large mortgages?
Well, this is an issue that we actually thought about last time we raised interest rates, which was starting in 2017. And then, you know, basically the issue was very much the same, that Canadian households are very heavily indebted. And so the implication of that is that raising interest rates actually has a larger negative effect on households, how much money households have left over after they pay their mortgage to spend on other things, and so it has a more negative effect on on economic activity than it does when households are less heavily indebted. Now, that's something that, of course, we would have to take into account when we're gauging what's the appropriate pace and timing of raising interest rates. I mean, as you said, I mean, certainly there will come a time when interest rates will be higher than they are now, but the question of when it's appropriate to start to move and how quickly will also take into account the fact that we're working with a different economy than we had even 2 or 3 years ago, and so we have to factor that into our decisions.
All right, and then expanding on this point, thank you to whoever put this one in the chat. The Bank of Canada traditionally increases the bank rate by 25 basis points at a time. Relative to the current rate, this would be a 100% increase and could potentially create a negative impact. Have you guys looked at using a 10 basis point move instead of a 25 basis point move?
I have to say that hasn't been a hot topic. I think the 25 basis points is kind of a convention. It's something that we've done for a long time now, and it seems to be well understood by most people. And generally, there hasn't been a sense. Certainly, when last time we raised interest rates from its current level was back in 2010. Because we had lowered interest rates down to 25 basis points in the during the Canadian recession associated with the global financial crisis. And, at that time, we raised interest rates from 25 to 50, then to 75, and so on. And that seemed to proceed pretty smoothly at the time. So obviously, we're going to have to watch as we move forward when the time comes to make sure that we're gauging the impact correctly. But that's something that we haven't really been focusing on.
All right, I want to thank you very much for your time. This last question is going to be the last question, and again, this one comes from the public chat.
A reminder here before we go into the last question of this phase that directly after this, I believe it's supposed to start at 2:00. We actually are going to have a press conference with Timothy Lane, the person who just did this speech, but actually reporters are going to be the ones asking questions. Saw people saying in the chat, "Hey Russell, when are you going to be able to call in?" Maybe if we get a couple more subscribers on the channel, it'll be a little more credible to maybe do that one day. That'd be pretty cool. But let's listen into this last question,
where we had over 600 people registered. So charts and statistics are telling us that over 25% of the currency that exists today worldwide was printed in the last 12 months. Does this affect our future monetary policy?
I don't think that can be right. Not specifically referring to currency. I mean, we've had, in Canada, we've, actually, if you think of currency printed, that's actually banknotes. And we have seen some increase in banknotes, mostly because a lot of people want some cash to carry around, but they haven't been spending it as quickly because they've been often using contactless methods of payment, rather than using cash to make payments. So there has been a slight increase in banknotes in circulation, but it hasn't been out of the ordinary given that change in how people pay for things. So certainly in Canada, there hasn't been anything like the explosion of actual printing of money that you're referring to. So that's that's certainly not also the case in other major economies.
All right, thank you. I'm actually being told that we have time for one more. So this one actually is right up your alley as in terms of specialization. But where does the bank see the future of cryptocurrency going? It's, I think, past the point of telling people that they shouldn't do it, and it's one of those things that is reality now. Where do you guys see it going?
Well, as we've said before, we see this current wave of cryptocurrencies, Bitcoin, Dogecoin, and all those other products as largely a speculative product right now. There are obviously a certain number of true believers who think that these will be the money of the future, but then clearly most people who are buying these things are doing it because they think they can make a quick buck. And for a while they did, but I wouldn't like to talk to somebody who bought Bitcoin a month ago. I think these things clearly have had a roller coaster, and largely because the supply is limited and the demand is really driven by people's belief that these things could be something they can make money on. So these same price movements actually make it impossible that these things could become the money of the future in the sense of being used to pay for things on a routine basis, because basically, you're not going to accept your wages and something that could drop in value by 10 or 50% in the next week or so. So most people are going to insist on something that's more stable. So that's basically our view of the cryptocurrencies. But at the same time, we do have a I think that it is important to recognize the fact that there is a lot of innovation going on in this space. And even if the current incarnation of these things is not useful for paying for stuff, then it still is actually leading to an exploration of technologies which may turn out to be very useful for some other purposes. And certainly it's very important to make sure that we can encourage the development of technologies that may actually subsequently be beneficial in either in the financial system or elsewhere. And so we're certainly very receptive to innovation in this area.
All right, thank you so much. That was our last question. And then I'm going to now pass it from Vancouver all the way to Winnipeg, where we've got Melissa Harrell with our closing remarks.
Okay, interesting.
Thank you. I just really wanted to take the opportunity to say.
So they're just gonna thank Tim Lane for being here. So like I said before, and I'll throw up chat here for a minute so you guys can hang out with me here. Like I said before, we are now going to transition over to some reporters who are going to have an opportunity to ask Tim Lane some questions. Now, obviously, a lot of interesting stuff just went down there. Comments on housing. At the very end there, we had some comments on cryptocurrency. I think it's kind of if you've been following the channel, you'll know that I'm bullish on cryptocurrency. I've been doing more and more research on it, and especially been interested in the decentralized finance side of things. I think that that's an incredible technology, and I think that that's the way things are going, and it seems like the Bank of Canada's view is a little bit limited here in terms of that. There was also a question there about inflation, and they essentially, let me recap here. They said that, or the person was asking a question saying, hey, we've printed 25% of global currency in the past year during the pandemic. Is this going to have a big impact on the world? And Timothy Lane responded to that question by saying, well, I'm going to interpret your question as you mean actual printing of banknotes, but I don't think that that was actually the spirit behind the question. I think that they were largely talking about M1 or money supply, right? That's the total money supply added to the system, not just the printing of actual physical bills and dollars, because these days money printing isn't actually a printing press. It's adding a zero at the end of a number on a database, right? So it was a little bit interesting to hear him answer a different question than the one that I thought was actually answered. But I'll show you here. We're on the Bank of Canada's YouTube here, and they have another thing set up here. I think if I go actually to the Bank of Canada's main page, we'll be able to get into that media. Yeah, right here, media availability for the Bank of Canada, scheduled. Okay, so it says it's scheduled for a little bit later. We're gonna hold on to this, and I'm gonna keep this up here on mine so that we can see what's been going on here and when that actually starts off. But while we wait for that, let's get into a little bit of a question and answer. What do you guys think of what they just said? I'm gonna pull up the chat here, make it a little bit bigger so I can read it as we go. I'm seeing lots of activity in there. If you haven't joined that community and said hi, I know lots of people in there are recognizing each other from previous streams, so make sure to get involved in the chat. I'm seeing most recently Alex and two different Alexes, and Raymond and Matt and William hanging out in here. William says, I invested in crypto before cutting drop. I drastically increased the amount of crypto coins I have, and many of those doing still have a number higher value than the Canadian dollar after drop. Yeah, interesting. There's lots of different strategies when it comes to cryptocurrency. I'm personally a big fan, and I'm very bullish on Ethereum and the sort of network that's going on there and all the functions and all the value that's being built on that network. Very interesting to me. Yeah, so everything has a higher value than the Canadian dollar. Yeah, maybe. Hey, Aram saying, hey, Russell. Yeah, Ninja is great. Hi, Russell. Looking forward to more bad news, but at least you make it easier for us to deal with. Well, I'm glad. Alex, you think ADA will flip Ether? Now, like I am bullish on ADA as well, but I just want to see more development and more developers actually on the ADA network and creating products, right? They've taken this sort of slower, more research-based approach to getting this network rolling, as opposed to the faster and looser strategy for Ethereum. Which one's going to play out long-term is interesting, but I would definitely need to see more projects being developed on the Cardano network to be even more bullish about that. Jason says CERB amnesty for low income may or should already be handled by income tax level, which should not even start until after a livable income is attained. Yeah, that's an interesting take on the policy from our government here when it comes to CERB amnesty. Yeah, there have been calls for an increased basic personal amount. That's the amount on your income taxes that you essentially have to pass in order to actually have to start paying this, right? You can deduct a certain amount of income as the basic personal amount, meaning that many of the lowest income earners in Canada don't have to pay as much in taxes or anything at all because they've made under that basic personal amount. Many people are saying, hey, we could implement a higher basic personal amount so that people can actually have a livable wage before they actually have to start paying back in taxes. See you later, El Ezra. Thanks for tuning in from the beginning of the stream. Charles Hoskinson's is 18x better than Elon. Yeah, maybe. Lots of people have some opinions on Charles Hoskinson. He's a very polarizing figure, it seems, but I think he's very well spoken, and the sort of the debates and the conflict that have been going on between him and the former team on Ethereum when he worked on that is definitely interesting. That tension there. Alex says, I wish the CPI reflected what consumers are actually consuming. Crazy to me that it's been so decoupled. Yeah, there have been lots of people who are certainly questioning the CPI and whether or not it gives you all of the data that you actually need to make these policy decisions, especially given the Bank of Canada largely looks at only the CPI when it comes to tracking their 2% inflation target. Yeah, good thought. I agree. Cryptos are mostly just speculative things. NFTs are great. So are smart contracts, DeFi, etc. But they won't work without a stable currency. And I don't mean a stable coin pegged to fiat. I mean a really stable currency, but right now people want speculative, unstable currencies. That's the problem. Yeah, maybe you're right, Dan. That's an interesting take. So you're saying like things like USDC and USDT that are supposedly backed by fiat currencies to make them stable, that maybe that's not actually a true stable currency. Now, I would say look into DAI, D-A-I. That seems to be a stable coin that's less tied to the US dollar, or like tied in more of a decentralized way. I need to look into that a little bit more to make sure I fully understand it, but that could be an answer to that question. The only reason used car sales are so high, rich people buying used Lambos, maybe. There certainly has been a shortage of used cars on used car lots. That's been interesting, and the effects of the chip shortage, right? And in global supply chains, that it's going to be interesting to watch. As a reminder for anyone just tuning in here, we are hanging out for the next little while as we wait for the Bank of Canada's media availability on June 10th. But I will give you a quick recap here. I'll actually show you my notes as I'm going through them, the notes that I took during that press conference, so we can get a summary and you can sort of give me some of your takes and what do you think of what they've said here. All right, so I'll full screen this. I take my notes in Google Docs. Let me turn off chat. So if you missed this press conference that we just had, well, this is going to be good for you because we're going to get a little bit of a recap here on what's going on. So this is from the Bank of Canada's live press conference. They said the Canadian economy is strong because of the CERB and the Canada Emergency Wage Subsidy and all of those supports going out to businesses. But they're really focused on a digital transformation, and we'll get more into that in a second. They said that there's been strong household spending, but lower GDP or gross domestic product growth than they were formerly expecting. And they think that the first half of this year is going to be strong in terms of the economy, even despite the lockdowns in certain areas of Canada. There were also 275 job losses in April and May. We just saw an additional around 60,000 as of the most recent employment data, keeping us over 8%. So they say there's still some slack in the economy in terms of employment, right? There's still room to grow our employment back to the levels of the pre-pandemic. So that's likely an indicator they're going to keep interest rates low as long as they possibly can. And about housing, they said that actually was a strong boost to the economy, right? Many people say that, hey, maybe the Bank of Canada isn't all that worried about solving the real estate problem because as they move more money or like essentially transfer wealth into people who have homes because of their inflation rates or rather the interest rates being low and the growth in the housing market, well, people can take out that money, do a cash out refinance or a home equity line of credit, credit, and then that money gets transferred over to businesses as consumers spend that money. So they're saying, hey, this is the growth sector in the economy over the past while when many sectors haven't grown. That's been a boost to the economy. And they think that that boom narrative, this is what they've been saying, is all about the fact that people want to move out of the big cities, and that causes growth and people really being stuck at home and wanting to like grow and renovate their homes, and that's why real estate has boomed. I'm more of the believer that it's interest rates heavy, and the fact that we don't have very favorable supply policies for or incentives for private companies to start building. I think that that could be a large issue, as well as the problems with zoning and the sort of the red tape there to build more houses, right? Because if we had a larger housing supply that could be built more quickly, well, then maybe this growth wouldn't be as extreme, and people might be able to get into a home. They say inflation was below 2% for a long time, but it just increased to 3.5. They're expecting that to last for the next few months, all because of base year effects or year over year effects, comparing to a year ago when we had deflation, right? Lower inflation because of the dried up demand for goods as everyone was sort of hunkering down, not knowing what was going to happen with the pandemic. So lots of interesting things there. We'll flip over for a second here and take a look at chat and see what your thoughts are on some of those things we just talked about. Jason says it's long past time for a UBI, guaranteed livable income, given that they already mentioned the Bank of Canada's speech situation with women and young people, not to mention gig workers being hit by automation. Yeah, the gig workers being hit by automation, that's, I think, one of the most salient points for a UBI or a GBI or a GLI, whatever you want to call it, basic income, right? I think that is the biggest idea, because we're through AI and automation and all of this growth in tech, we're going to see a lot of job losses, and almost like the AI and tech can take over a large portion of the work that humans have been doing for decades, right? And thinking about how we can allow for that work to be done by this automated process and AI while still being able to live as humans and be able to actually have the money to continue in the current system. That is an interesting point, and it'll be interesting to watch as we go on here. Alex K says, I'll be watching the Senate chambers at 2 p.m. They'll be voting on legalizing gambling today. Okay. Legalizing gambling in what way, Alex? I haven't been following that bill, C-218. Interesting. No key starters and tracking enabled and can be shut down via satellite. Not something is a good thing. What if they have too much incentive to not build, i.e. hoarding is too profitable? Oh, like you're saying these. Well, it depends on what you're talking about. Are you saying that these big companies are just buying up a bunch of real estate and don't want to build more, so the prices go up? I don't think that some of these construction companies and the ones that are building new houses are really the ones that are buying up a lot of residential real estate. There could be some people building like apartment buildings that are doing that, though. Any insights into similar rule in USA with the 1031 form, capital gains tax transfer? Do you have anything similar to it? I know of Section 484, but that's very limited. Yeah, so Alex, interesting question. In the States, there's something called a 1031 tax exchange, and it allows people to move assets, sell assets, and not pay any capital gains tax on the growth of their assets, so long as within a given time frame, they're able to transfer over that into a new investment. It's largely used by real estate investors who will have some capital growth in their property, sell that property, and potentially have hundreds of thousands of dollars of gains that would be liable to, or that they would have to pay capital gains tax on. If you can 1031 exchange that, well, then you don't have to pay the capital gains tax, and you can sort of transfer that into a bigger property, right? Essentially pushing forward the tax liability and sort of pushing it off all the way until they die, right? Never having to pay it. That's what a 1031 has done. You can't do that in Canada. There's no 1031 here in Canada. So, yeah, there's been talk about Joe Biden was trying to get rid of the 1031 exchange. I believe that was a big issue that they were talking about as of recent. Single game betting will be legalized, so we can bet on oh, okay, so some more sports betting. Nice. So we'll no longer have access to keys. Okay, interesting. All right, let's flip back to some of these notes from what was said here. Again, we're transferring over just in 1 second here. Yeah, it says we've got 13 minutes until this Bank of Canada press conference is on with Timothy Lane. I'm surprised that they didn't just like like go until the end and just like have a full press conference. Usually it transfers over better, but I guess they're waiting for this now. But we're going to keep this up here to make sure that we're aware of when it actually starts. Okay, so they had some questions about inflation. They say that they expect it to stay at 3% over the next several months, blaming that all on base year effects, saying it's transitory, it's going to go away. This is just short term that we're going to see this 3.5% inflation. But the thing you need to be looking out for, and that's on June 16th. June 16th is when we're going to get the new inflation data. Now, they're expecting it to be around 3%, 3.5% in that range, very similar. But if we actually see some month over month growth, like this 3.4% grows to 3.8, 3.9, well, that probably wouldn't be the most expected because we haven't seen an equivalent drop the year before. So you couldn't really blame it on base year effects or transitory data, like looking at a year ago and how that affects the data now. Like you can't really see that if we see some month over month inflation. So that's what I'm going to be looking at about, I think it's next Wednesday, we're going to get that data. So that's going to be interesting to look at. Okay, we also have, they talked about the semiconductor chip shortage. Supply chain bottlenecks will probably ease. It's good for inflation if these bottlenecks ease, right? So they're going to be monitoring that. And they're saying they're going to hold that 2.25 overnight rate until slack is absorbed. And they think it'll be the second half of 2022 that happens. And they're going to keep their quantitative easing going at $3 billion per week. Now, if you're someone who's tuning into the stream or this channel for the first few times, you might not recognize that term quantitative easing. Essentially, this has been a new tool that's been used for the first time by the Bank of Canada since the start of the pandemic, and they use it to push down interest rates. Essentially, what happens is the Bank of Canada prints initially at the beginning of the pandemic it was 5, now they've tapered it to 4 and $3 billion per week printed by the Bank of Canada. Now, it's not printed in the traditional sense. This is how it works. The Bank of Canada or the government of Canada will put out government of Canada bonds, essentially IOUs that investors can take and hold in their portfolios to give the government of Canada a loan. Now, the Bank of Canada, from the people who buy these government of Canada bonds, the Bank of Canada said, hey, we're just going to buy up all of these secondary market government of Canada bonds. And what happens then is when you have increase on supply side or on demand side pressure, that will push up the price of these government of Canada bonds. And the way that bonds work is that the yield on the bonds is inversely correlated to the price of the bond. So for lack of a clear explanation, this just means that when bond prices go up, interest rates go down. Because the Bank of Canada is buying so many bonds, the bond prices have gone up because there's more demand for them. Interest rates go down because of that. That's essentially QE. And it's provided a lot more liquidity to the system and liquidity to the big banks. And that's essentially what has been happening with QE. I find that so interesting the way that it works. Okay, we got a question here from Brent saying, what are your thoughts on MetaMask? I'm a MetaMask user. I use that for as my Ethereum wallet and my ERC20 wallet. And I've been using it more and more lately as I've been getting involved in the decentralized finance community, using it to check out some of these side chains on Ethereum like Polygon or Matic. That's been interesting, and I'm going to be checking out some of those layer 2s for the scaling Ethereum, like Arbitrum and Optimism. That's going to be interesting to look at, but I'm using MetaMask for all of that. Yeah, maybe I sound a little bit loud, but Boo Bay is saying that. Pirate Coin, yeah, interesting stuff here. Wages don't have to move to make value of work go down by raising cost of living. That interesting take, Ninja. Thoughts on CCP taking advantage of Canada's real estate, politics, and academia? I'm going to need a little bit more context on that to give a take. Alex K says, reverse repo counteracts the effects of inflation, money printing, or QE, which is why inflation expectations should be overlooked. Those uninformed will have this simplistic view on the monetary system. Okay, I need to do a little bit more digging on that. Certainly, I believe that there are some deflationary pressures. Like I said at the beginning of the stream, that when you have this adoption of new tech and more companies taking into consideration ways that they can implement AI and these new technologies that help them to cut costs, well, sometimes those cut costs are passed on to consumers. You can sort of think about this like buying a TV 10 years ago. To buy a 50-inch, you'd be spending thousands of dollars. Now you can buy a 50-inch TV for what, right? $250, even sometimes $300. So that's pretty interesting. That's pretty interesting to me, and I think that can be a real deflation driver. Scott DeRosa says, "Are you yield farming with Matic on Aave?" I'm not yet, but I've actually been working on on transferring over and trying that out. And I think it's a good idea. I'm just doing it with a small amount of money just to play around with the system so I can get a better idea of what's actually happening in DeFi. Good question, Scott, but it's definitely something I'm going to be trying. Yeah, like even just like last night, I spent an hour trying to like figure out how does this work, because it's not very consumer or user friendly right now, right? But since we've been talking about it, let's talk about what the Bank of Canada has said about cryptocurrency, because I was expecting a little bit more of a bullish or a crypto positive response from Tim Lane, because he's been the one driving this Bank of Canada central bank digital currency narrative. But here's what they said about crypto here in that very final question of that press conference. Then these are his words. He said that it's largely a speculative product right now, but there are a certain number of true believers that believe that tech is going to be here long term. But he takes the opinion, and the Bank of Canada takes the stance, that most people involved in crypto are only doing it because they think they can make a quick buck. Now, that has got to be just anecdotal, right? Like I don't think that they have any data saying this is why people are buying it, just to make more money and expecting it to go up forever. Certainly there are tons of people who are doing that, but I believe that there are tons of people who are actually believing in the tech and the vast changes this can have on the future, rather than just trying to make a quick buck in those systems. A little bit of a limited scope of view there from the Bank of Canada. They say that supply is limited of these cryptocurrencies, and that demand is only driven by people's belief that this is something that they can make money on. I don't believe that's entirely true. I believe it's a part of it, but I believe that there is a lot of demand because there's actual value being created in these systems, especially around the world. When we think about other countries that are unbanked and the populations are largely unbanked, well, this gives them a potential opportunity to access the financial services that we've grown accustomed to here in more developed countries. They said that the volatility of these cryptocurrencies stop it from being a true currency that we can use to transact. It's an interesting take, largely why Bitcoin has dropped the narrative that it's supposed to be a means of transaction, switching into a store of value as its primary narrative. Much like gold, we don't use gold to transact today, but we can use it to store value. Now, there are lots of other cryptocurrencies that would work better as a transaction, especially ones that have been scaling up lately in terms of the amount of transactions that can be included on one block, while still having the decentralized security that comes with having smaller block sizes. So it'll be interesting to see how that pans out. And many people believe that as we have more large adoption of cryptocurrency, if that's something to happen, that volatility could go down. He also says that he thinks the tech of these cryptocurrencies and like blockchain behind it is good, but that the current incarnations may not be good. But they're definitely interested and receptive to innovation in that area. So that's interesting what their takes are. I'm probably going to make a video on that, sort of talking about my views in comparison to the Bank of Canada's. I'm definitely bullish on cryptocurrency long term, and I think that people should look into DeFi and the impact that can have. Candace says that I would say that the get rich quick theme is true when talking about meme coins. Yeah, I think in many cases there is a lot of that, and a lot of that on YouTube too. Like people just pushing these coins that like I think it's a lot of people who don't know a lot about cryptocurrency and aren't willing to spend the hours of time that it takes to research and understand what's going on behind all of this to really understand, like, hey, is this cryptocurrency solving a problem, right? Or is it just something that people are trying to diamond hand to the moon to try to get rich, right? That's where I think the distinction lies. Good point, Candace. Alex says he's been mining Bitcoin on your gaming rig for the past year or so. Cool. That's awesome. I haven't done any mining. Iron Oxide says ETH 2.0 will do well. I think so. Yeah, once it transitions over to proof of stake. Joe S says, do you think the government would ever adopt crypto here in Canada? Now, I don't think officially they would ever adopt Bitcoin or something like Ethereum or ADA or whatever your cryptocurrency of choice is as a formal official currency of Canada, much like El Salvador did with Bitcoin recently. I don't think that that's likely, especially given the central bank is looking to implement a CBDC or a central bank digital currency. I'm just going to flip over here and make sure this is still, yeah, we're still waiting on this. We're about 2 minutes away from when Timothy Lane is supposed to come on here to answer more questions. But I think, yeah, the Bank of Canada right now wants to build a CBDC, and it makes sense for them to want to implement a digital currency because of the amount of control it gives them over the economy. Right now, I think that central bankers are, especially if they're more informed about what's going on in cryptocurrency, must be a little bit scared right now because the adoption of cryptocurrency takes some power out of their hands, right? If they're not the ones who control the issuance of the currency, which they certainly wouldn't with Bitcoin or Ethereum or whatever else, the list goes on. I'm not omitting things intentionally here, but certainly they wouldn't be able to control the issuance of that currency. They wouldn't be able to control where it goes, how it moves, which with a CBDC they essentially could. Imagine this for a second. If we have a central bank digital currency with ability for smart contracts that like allow you to provide logic into the way that the currency functions through programmability, well, I think that, imagine this. Imagine we already had a central bank digital currency. We have the pandemic. We need to get stimulus out to people through something like the CERB program that happened. Well, one of the largest criticisms of the CERB and the CRB is that it was going to some people who didn't essentially need it. And we saw teenagers and buying new shoes and buying MacBooks with this, and because they were still living at home but able to receive it. That was a big criticism of the program. With a CBDC, the Bank of Canada could essentially say, hey, here's all this currency, but we're putting limits on how and where you can spend it. You can only spend it for essential goods, rent, these things that they're actually looking to try to stimulate, right? That's really, really interesting to me. And a large reason I think that the Bank of Canada is going to implement a CBDC because of that flexibility and control it gives us. Brent says, and thanks for the super chat, Brent. That's so nice of you. Why does MetaMask require complete authorization of all my browsers and content? That makes me concerned. Your thoughts, please. Yeah, that is something that people are concerned about, having the MetaMask being able to see your browser content. But you can actually go in there and right-click on the browser. Yeah, you can right-click on it, and you can change when the MetaMask can read and write on your site data, and you can change that so it only reads and writes when it's when you click on the extension, so it gives you a little bit more privacy that way. Certainly, if you don't want to use MetaMask, you could use something like a cold storage wallet here. This is a Ledger Nano X, and it's what I use, and I actually have it connected to my MetaMask. It's an extra layer of security, a cold storage wallet where your private keys are held. So that's definitely something I would recommend to people getting into cryptocurrency. There's a link down there actually in the description if you want to check that out, the Ledger Nano X I'm a big fan of. Again, we're still waiting here for Timothy Lane to hop up. We're expecting him to give a little bit of a summary of his speech potentially and get some answers from answers to some questions from reporters here. All right, so Alex says VPN solves all. I don't know the context of that, but I definitely think that that's okay, we've got it starting here. Let's flip over and we'll see what's going on.
Mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *7. Pour mettre votre ligne téléphonique en mode discrétion, appuyez sur *6. Faites *7 pour l'enlever. So we're going to start with Tony Mace, followed by Shelley Hagan and Mark Rendell. Go ahead, Tony.
Hi, Deputy Governor. It's Tony Mace at Mace News. Thanks for doing this. In your speech, you alluded to the issue of difficulty firms are having in the U.S. in rehiring their employees. And you mentioned that as a possible concern in the Canadian context. Can you talk a little bit more about that? Are you seeing that dynamic develop in Canada, and how do you see that as a potential upside risk to your inflation target? Thank you.
Well, certainly we have heard some reports of labor shortages, and particularly with regard to more highly skilled workers. And, of course, as I highlighted in the speech today, workers with tech skills are particularly in high demand. And this isn't a new issue in Canada. It's one that we've seen for some time. And so that is certainly something that we're observing here. At the same time, of course, we still do have half a million people who are out of work, that relative to those who had jobs before the pandemic broke, and so there's an overall degree of economic slack in the labor market. So that when we're thinking about inflation, obviously you've got some specific, you don't have sort of an even amount of slack in every sector and for every occupation, but you have differences across different types of occupations, and that, of course, could affect how wage pressures materialize. You would expect that wages might start to get pushed up in occupations where workers are in short supply, but meanwhile they might stay very moderate in other occupations. So this is something we're just going to have to watch as the economy reopens. I mean, maybe a broader point here is that this has been such a huge and an unusual shock that the economy's been through, that there are quite large structural changes going on in terms of which industries are going to do well after the pandemic. That may change relative to what happened before the pandemic, and what jobs are going to be available. And so a lot of those things are going to condition both how the level of economic activity recovers, but also how inflation comes back. And a lot of that we're just going to have to look at as much information as we can and assess it as it's taking place.
Next, we'll go to Shelley Hagan with Bloomberg News.
Hi, Deputy Governor. This is Shelley Hagan from Bloomberg News. It appears that the Bank of Canada has been more aggressive in its slowdown of stimulus than the U.S. Federal Reserve and some other central banks in terms of its reduction in the QE program and in its forward guidance. And why is that? And particularly because the U.S. appears faster in its reopening and recovering than than Canada.
Okay, that's a good question. I think the starting point is that we make these decisions with regard to economic conditions in Canada. We're guided by an inflation target. Obviously, the U.S. is faced with somewhat different economic conditions, but they also have a different monetary policy framework. They have a dual mandate for where labor market conditions are the maximum employment is also an equally important goal for them. The other thing, of course, is that they recently revised their framework to, in particular, to actually seek to bring about an overshoot of inflation above the target, rather than targeting 2% inflation, and that is based on a sort of a soft form of average inflation targeting, which seeks to sort of make up for periods of low inflation by having higher inflation afterwards. Whereas in Canada, we still aim for 2% going forward, although what we really aim for is 2% on a sustained basis. Now, perhaps those differences are a little bit I mean, they can be a little bit exaggerated in the sense that even though we don't have a mandate for maximum employment, at the same time, we do take account of labor market conditions very much in making our assessment of when inflation is sustainably on target. And also, even though we don't aim for an overshoot, at the same much in making back to target in the midst of a very large economic shock, we're being aggressive in a way that implies that it's quite likely to overshoot, and we're actually seeing at the moment inflation above target for reasons that we've identified as being temporary. So with all of that, basically we are making the decisions we're making. We are seeing we have forward guidance which is formulated in terms of outcomes, and so we basically have committed ourselves to keeping the policy rate at its current level until inflation is sustainably on target. But as the data come in, which imply that condition is likely to be met sooner than expected, then we change the date that we attach to our forward guidance accordingly. And that's just the nature of an outcomes-based measure. With regard to the QE program, Canada, I guess because of where we started, we'd never done QE before. We ramped up our balance sheet very quickly, and we're now in a position where we've taken a step to stop adding to our balance sheet at as quicker rate as we had been doing, and we see that as appropriate in view of Canadian economic conditions currently. So that's sort of where we are.
Next, we'll go to Mark Rendell, followed by Julie Gordon and Jordan Press. Go ahead, Mark.
Hi, Deputy Governor. Mark Rendell here with Globe and Mail. Wanted to follow up quickly on the QE question. It looks like in the past couple of weeks, the banks undershot the $3 billion target. I think it was about $2.6 billion one week, 2.8 the other week. I'm wondering if you can explain what's going on there, and if this undershooting on the downside is in any way, a way to kind of incrementally withdraw stimulus without being explicit about lowering the target.
Okay, well, first point, we have a $3 billion a week target, but that doesn't mean to say we have to hit it every week. We basically go into the market trying to get $3 billion, but then how much we actually buy is based on what's offered to us in the market. And so there may be variations in market conditions, which imply that some weeks we might buy a bit more than $3 billion, and others we might buy a bit less. So that's nothing mysterious about that. It's basically just a reflection of the fact that, it's not a minimum, it's a target, so we could end up, just because of market conditions, being on one side of it or the other. The other thing is that, maybe to highlight here, is the fact that if we're going to scale down how much QE we're doing, we'll tell you. We made quite a clear announcement in April that we were scaling it down from 4 to 3, and if we decide to scale it down further, there's no reason we would not want to make an announcement. So that's something that we'll do when the time is right.
Next, we'll go to Julie Gordon with Reuters.
Oh, hi there. Thank you, Deputy Governor, for taking our questions. I'm just wondering if could some of the increase in underlying inflation be an indication there's less slack in the economy than the central bank has been projecting?
Well, there's certainly a possibility that that's the case. And, we've also, I think related to that, we've highlighted the fact that in certain sectors, there are clearly bottlenecks, and particularly we've seen the shortages of semiconductors, of shipping capacity, and various other things, which suggests that there may be excess demand for some types of inputs and raw materials. And obviously, at this point, we see this as being, our baseline interpretation is that that's something that's temporary. It's something that reflects how rapid this whole process has been. The fact that not just Canadian, but the global economy shut down very rapidly but unevenly last year, and it's been reopening also very rapidly. And as it reopens, you've got some imbalances where certain things are in short supply, and so you do have have upward pressure on prices of some of those important inputs. But of course, that does create a risk to inflation, and it's one that we included among our key risks in our April monetary policy report, and that would suggest that, if those pressures on capacity actually persist, then we could actually see inflation above target in a more persistent manner. And if that happens, of course, that would have implications for our inflation outlook and also for our monetary policy going forward.
For reporters joining the call who were late, if you have a question, let us know by sending an email to communications@bankofcanada.ca and we'll put you in the queue. Pour les journalistes qui se sont joints à l'appel avec un peu de retard, envoyez un bref courriel à communication@banqueducanada.ca et si vous souhaitez poser une question, on ajoutera votre nom à la liste. So next up, we have Jordan Press from the Canadian Press. Jordan, go ahead.
Good afternoon, Deputy Governor. In your speech, when you talked about the effects of automation, for instance, in the workforce, I'm wondering how big of a concern is this for the Bank of Canada, given you had a recent staff discussion paper that actually said this wasn't a huge problem in the near term? And even if it is a big concern, how does the Bank of Canada actually go about addressing it to help the workers who are going to be affected most by it?
Well, generally, big technological changes have very uneven effects on different groups of workers. I mean, you have, typically some workers who are displaced by technological advances and others who have new opportunities. And at this point, certainly a lot of analysis that we've seen suggests that this latest wave of transformation should not be any different, that, we'll see fewer jobs for tasks that can be more readily automated and more jobs for occupations that require more judgment, more contact with people, and more other things that can be more effectively done by human beings. And of course, the issue is that the people who are qualified to do those other jobs are not necessarily the ones who've lost the jobs that have been displaced, and of course that's a challenge for all aspects of policy, but it's particularly a challenge for areas that are not within the Bank of Canada's control, but particularly job training and labor market policies that can ease the transition of workers from jobs to jobs that require those different skills and qualifications. And of course, basic education needs to make workers, graduates more adaptable, able to learn new skills and develop the kind of critical thinking skills and other things that enable them to adjust to a variety of different kinds of roles in their future careers. And so all of those are things that, again, it's not part of the direct responsibility of the Bank of Canada, but something that we should all be thinking about as these developments unfold. I mean, of course, for the Bank of Canada, the main issue is what it does to potential growth of the economy, and to the extent that it could imply higher productivity and higher potential GDP going forward. That would imply that the economy could grow more before inflation becomes an issue, and so that would have implications for how we would conduct our monetary policy.
Next, we'll go to Greg Quinn, followed by Kim McCrail. Greg, go ahead.
Good afternoon, Greg Quinn with Market News International. I wanted to ask how much the Bank of Canada really needs the QE bond purchases now in any form. And I ask this because they were born in a very different economy without vaccines. Inflation is above the top of the Bank of Canada's target band. And even before this phase, many economists saw QE as really a second best solution. And finally, we have major fiscal stimulus online that's likely more effective for targeting the job market. And we have a strong U.S. economy boosting demand and a commodity boom. So in that world, why do we need to be buying bonds?
Well, I guess to go back to last year, of course, the initial purchase of the bond purchase of the bond purchases was really to help address some of the tensions in financial markets. It was really the fact that at the time there was a need for us to intervene in order to bring about more orderly conditions in bond markets, which are in turn are a benchmark for lending rates throughout the economy. And of course, that purpose changed during the course of last year to become part of monetary policy stimulus, and the purpose, as this evolved, was to try and pull down borrowing costs along the yield curve. But as you've highlighted, of course, circumstances are changing, and our April outlook suggested that we're now seeing signs that the economy is actually coming through better than we had previously expected, and all the things that you mentioned are factors in that. And as Governor Macklem mentioned in his press conference in April, if things unfold the way that we see them unfolding, then we should see a reduced need for us to do anything to stimulate the economy as we go forward, and that's obviously reflected in the step we've already taken towards reducing the amount of QE, but it's also reflected in the fact that in April we took on board the new information, and that implied that we would be expecting to start raising our policy rate from its effective lower bound sooner than we had thought in the past. And so, of course, we've been mindful of the severity of the shock and the experience of the recession after the global financial crisis, that it's important to make sure that the economy is well on its way to a full recovery before we're starting to scale back our stimulus. And that's, we're mindful of not wanting to let the economy slide back and making sure it has the support that it needs. But as we can get increasing signs of that being the case, then of course we will be making further announcements on with regard to to our QE program.
And we have time for one last question, and it will come from Kim McCrail with the Wall Street Journal. Go ahead, Kim.
Hi, thanks for this. Your speech today mentioned that as of April, Canada's export markets were improving, largely because of the rapid vaccination rollout and substantial fiscal stimulus in the U.S., so export markets to the U.S. To what extent do you think this will continue to be the case, and what role is U.S. economic strength playing in the Canadian recovery right now?
Well, certainly the U.S. is a very important driver of Canada. I mean, they buy 3/4 of our exports, and the two economies are very closely integrated in a lot of ways, and so there is certainly a major impact. And certainly all the indications in the U.S. are that they're still having a very strong economy, and they've got a lot of fiscal stimulus underway and more spending on infrastructure in the pipeline. So all of that is generally going to be favorable for Canada. Of course, one factor that will affect how much we can benefit from that is the Canadian dollar. And so far, the Canadian dollar has been pushed up by the rise in oil prices and other commodity prices, which is largely a good news story. It's reflecting the fact that the world economy is looking better, and that's pushing up the prices of those products. And it's also, I think, reflected in a better outlook for Canada, which is a factor that is pushing up the Canadian dollar. But if that appreciation of the Canadian dollar were to go too far, it could start to become a challenge to Canadian manufacturing exporters, and that would reduce our ability to make full use of this U.S. expansion.
And that concludes today's press conference. Thank you. Merci.
Okay. So some interesting stuff there in the final questions there from the Bank of Canada press conference here with Timothy Lane, the Deputy Governor of the Bank of Canada. So a quick summary on some of those questions that we just saw. We had one question about labor shortages in high-skill workers, essentially saying that this is a concern for Canada, the fact that there's not as many high-skilled workers staying in Canada, some people moving out of Canada, especially some of our best and brightest, as well as that sort of tying in to the idea here that there's a large digital transformation happening in Canada, and how the Bank of Canada is kind of concerned about that, the fact that so much is transitioning into digital, because they don't really have the ability to solve this automation AI issue, because it's not in their mandate to do so. They're sort of leaning on politics and the government of Canada to be able to, and individual, provincial, and municipal governments to give the kind of training and progressive education that's really necessary for this transitioning economy, right? I think a lot of the jobs that people were in pre-pandemic, well, there's going to be less of them post-pandemic. And many, I think it would be a good time now to start reskilling Canadians for a new, more digital, more growth-based economy. It's going to be interesting to see how that plays out. So many interesting things there. Questions about QE and how come we are tapering our quantitative easing program earlier than the States is. And he says that's because the Bank of Canada has a different mandate from the the Federal Reserve in the States. The Federal Reserve has a dual mandate to keep inflation at 2%, but also to consider the labor markets as well. The Bank of Canada, it seems like their chief concern is just keeping at that 2% rate. So he says that there's changes based on that, as well as the fact that U.S. was already doing QE before the pandemic, and now they're continuing to do it, whereas the Bank of Canada started anew, and they see it as appropriate to sort of start tapering QE now, but it seems like they're going to stay at that $3 billion rate for the next little while. With all that said, I think we're going to wrap up this stream here, unless I'm going to stay on for a couple more minutes. If anyone has any pressing questions, you can do at Russell Matthews in the chat, and I'll do my best to answer them here before we end this. But again, if you are just tuning into the stream, keep your eyes on the channel, hit the notification button, because I'm likely going to come up with a summary video of this so people don't have to watch the whole almost 2 hours of this live stream to get all this information. I'll sort of parse it down for people as well. So make sure you hit that button so you can get the notification when that goes on. All right. I don't think there are any major pressing questions here. So I think we're going to, we have one question here from Cortha Combat saying, what would you steer new homeowners to with today's markets, variable or fixed interest rates? Okay, that's a good question. There are different mindsets on variable versus fixed interest rates. Obviously, one of the benefits of fixed interest rates is that you lock in that interest rate and you get that for the term of your mortgage, usually 5 years. But there are some interesting arguments that say variable, it's often lower than fixed, certainly as of recent. But also there's an argument that it could sort of be a way to make sure that you're going to be used to affording higher interest rates at the end of your period. Let me explain what I mean there. Essentially, if you lock in an interest rate right now at like 1.8%, some people have gotten interest rates that look like that. I know, super low. But if 5 years from now interest rates are at 4 or 5%, well, that would be a big shock when you have to go to refinance and make these bigger payments. Many people argue that having a variable rate mortgage, well, it's kind of like you're getting used to it over time, because as the interest rates slowly go up, well, your payments also go up. It could be less efficient long-term in terms of the actual amount of money you pay, but it also can be good for people as sort of like a slow easing into paying more on your interest rates. So some benefits there, as well as, of course, for variable rate, oftentimes there's less fees to break that mortgage, which can be hugely beneficial depending on what your financial plans are. So that's my current thinking right there on that, Cortha. Michael says, do you have a module on corporate finance in your course? No, currently I don't have a module on corporate finance. But again, course members have the ability to, again, he's talking about the Canada Money Mastery Program down there. There's a link in the description. You can get 40% off with coupon code GROW. We've got a ton of people in there. But as a course member, you're actually able to request content to be created. So anything that you're looking for, there can be eventual future content if you put in a content request there through the private Discord. Thanks for the question there. And Dave says, I missed most of it. Any news on a digital Canadian dollar? less than I would have expected from Tim Lane. We did have some talk on cryptocurrency. Largely, he thinks it's a speculative asset that doesn't have a whole lot of value, and the value is from people thinking that it's going to go up, trying to get rich. I think it's a little bit of a dated view on cryptocurrency if you want my opinion on it. But again, I'll have more videos on that on the channel and what they said in comparison to my thoughts here in the next little while. All right, so I think on that point, I'm going to call it. So thanks to everybody for tuning in. I really appreciate you hanging out here. If you haven't already done so, subscribe to the channel for more content like this, share it with your friends, and check out the links in the description where you can open up investing accounts, start taking your wealth into your own hands. And again, that course is down there, 40% off with coupon code GROW, I believe, for the Canada Money Mastery Program. And with all that, thank you so much for tuning in, everybody. I really hope this stream's helped you out at least a little bit, and I'll see you next time. All right, have a good one, you guys. I'll see you soon.